Saugata Bhattacharya, economist at Axis Bank, joining in on the show. Saugata, thanks very much for joining in. First, to start off with, you do have the RBI, who has also acknowledged that the borrowing program this time is going to be rather difficult and it is going to be a major challenge. No commitment is given just as yet. Would you share the same view?
Yes, it is a bit of a challenge. The headline numbers of 4,79,000 crores that we've heard. And there is always a likelihood of that slipping down a little bit from those numbers. Given the slower pace of growth, given the probably high continuing liquidity deficit, probably a slightly slower deposit growth rate, all of these would suggest that the mismatch between the supply and the demand would, if not as bad as last year, probably remain relatively marked. So given this, there is a problem. There is a problem with the offtake of the paper that's likely to come in.
Saugata, typically we see every year that the government front loads its borrowing program, so a large part of it is done before September. We're again talking about the likelihood of that happening this year again. Bond deals, should we expect that they will stay under a fair bit of pressure going up until September at least?
Current indications seem to suggest that yes, that there will be some pressure. Part of it, of course, part of the current, the recent swing up in bond deals, sell-off in bonds, has probably been to expectations, nervousness about the RBI's potential reaction. The amount of significant, the extent of rate cuts that we were expecting just about a few days back, that probably has, we need to adjust that a little bit downwards, given the surge in inflationary pressures after the budget and from other external indicators. So given this and given the extent of the borrowing that will probably be front-loaded, exactly as you said, 65-60% of the total borrowings that will come in the first half, and with potentially tight liquidity going in, although liquidity will certainly ease in the first couple of months. But even given that, this combination of factors and all of this still hinges on the way that the rupee behaves. Because if the RBI is forced to intervene again, that will again take some liquidity out of the system. So unless there is significant OMO support right in the beginning, right in the first half, the first quarter probably of FY13, bond deals probably not likely to come down too much.
Sure. So, but Saugata, now just if we had to look beyond September, all things remaining equal, we're talking about something like 70,000 crores coming to the government through non-tax revenues, 40 from the sale of 2G spectrum and 30 from disinvestment. Assuming that does go through, assuming market conditions are supportive of those two exercises going through, inflation by that time is expected to come off because of, at least in large part, because of the base effect, and the fact that you've front-loaded the large part of your borrowings program. Can we expect that bond deals will come off, quite substantially in the second half of the year?
They will. I mean, exactly as you said, the first trigger for the yields to come down will be the RBI's rate cut trajectory. So, assuming that they cut rates by 75 to 100 basis points, and that will probably be front-loaded, also be front-loaded in the beginning of the year, given that inflation is likely to start moving up from September or October onwards. If liquidity, if the pressures of supply and demand of government papers and market borrowing, the size of the market borrowing program, if these remain in line with our current expectations, then obviously rates will begin to follow the trajectory of these policy rates. If not the entire amount by the 75 or 100 basis points, you would typically expect them to come down to at least by 55 basis points, yes.
Also, from the number of concerns that you did mention, liquidity is also likely to remain tight in the near term. What's your sense as to how that's likely to pan out?
Well, certainly far higher than we had expected at the beginning of the year. We can probably explain the current surge in liquidity, in the deficit in liquidity, because of these are operational factors. So our guess is that we will probably come down to about 80 to 90,000 crores by when you come in April. You've seen from the last WSS from the RBI that the government has parked a significant amount of funds with the RBI, 79,000 crores. So that's the extent of the taxes that they have probably collected. So that's likely to come into the market. Other taxes will start coming in April. Presuming that there's no significant deterioration in the current account and some capital flows come in, I think liquidity from that angle at least, I think we'll get some relief in April and probably going over all the way into May.
All right, Saugata, thanks very much for coming in on the show and giving us your perspective on the borrowings program for the first half of the year, the calendar for which will be put out by the government, the finance ministry, later in the day.